The markets have taken a turn and interest rates are changing and not in our favor. I'm going to talk about that and more on this month's monthly economic update. Welcome to the Modern Wealth Management Monthly Economic Update. I'm Dean Barber, Managing Director in our Lenexa, Kansas location. So the month of April was a little bit of a shift from the first quarter. We actually saw interest rates rise on the 10-year Treasury. We saw equities fall pretty much across the board, and we're getting a negative rating on one index now and a neutral rating on the balance of the indexes. Let's dive right in by taking a look at the indexes, and I'm going to sort these for the month of April here real quick. And so if we look at the month of April, the Russell 2000 was our worst performing sector, down almost 6%, and the only actual index that's negative on a year-to-date basis by 1.81%. The Russell 2000 also now flashing a bearish sign, and so a little bit of caution there in the small cap space. When we look at the rest of the indices, everything now is neutral. If you recall last month, you go back and look at that video, most of these were, neutral plus or maybe even into positive or bullish territory. But what we're seeing happen here, let's pick on the S&P 500 for an example. Out of the 500 stocks in the S&P 500, we have 113 that are still rated bullish. 311 are now rated neutral, and then 72 are rated as bearish. And so the S&P 500 was negative by 3.86% in the month of April, still positive on the year by 6.21%. So what is happening in the equity markets right now is all tied to what's going on with interest rates. The markets really raced up in, let's go back to October of 2023 up through the end of March of 2024. We saw the markets on an absolute tear, and what had happened was Federal Reserve Chairman Jerome Powell had mentioned back in October that he saw as many as 6 rate cuts coming in the future. Well, I think the markets really thought those 6 rate cuts are coming in 2024. We never really believed that we would have 6 rate cuts in 2024. We thought maybe a couple of rate cuts in 2024. Now, I think we're going to be lucky to get 1 rate cut, and if that rate cut does come in 2024, it's likely going to be in the fourth quarter. Now, we did have Powell say something that I think is positive, and that is he's not going to wait until the inflation rate gets down to the target of 2%, because if he does that, that means he's waited too long, therefore risking a recession. So we do believe that we will see the Fed act when appropriate, and I think there's a high possibility that we see at least 1 rate cut this year, and then maybe 3 or 4 rate cuts in 2025. That'll all remain to be seen. When does that happen, and how does that impact the markets as a whole? That's the big question. Let's go to the actual yield curve that we've been talking about here for the last several months. And you'll notice on the yield curve, we're still at a very inverted state on the yield curve. So I want to point out a couple of things here. I want to point out the 3-month Treasury on April 30th was yielding 5.46%, and the 10-year Treasury on April 30th was at 4.69%. So still a big inversion there with those long rates much lower than the short rates. Now I want to take you back just 1 month, and so we'll go to the end of March here, March 31st, and I want you to notice something. The 3-month Treasury was at 5.46, so the 3-month Treasury didn't move at all during the month of April. However, the 10-year Treasury was only at 4.2%, so we've seen a significant increase in the yield on the 10-year Treasury. That has also caused some issues with bonds. Now, I still think what I've said over the last several months, that there's going to be a tailwind for bonds coming, and this is a great entry point for bonds because a lot of bonds can be picked up at par value or maybe even a little bit lower. So I'm not going to let a little bit of an increase in the 10-year Treasury persuade me that this is not a good opportunity for bonds, because I think if we take a look out and at the next 18 to 36 months, Interest rates are going to be lower than where they are today. That's going to be a positive for bonds. It's also going to be a positive for stocks. The wild card out there today, there's actually a couple of them. One of them is what's going on in the Middle East. Should this become a more regional conflict, getting the United States pulled into that conflict, that could cause energy prices to soar. Those energy prices going up obviously is going to make inflation remain very, very stubborn, and that could limit Powell's ability to lower rates. That kind of is my worst case scenario at this point in time, leading to the possibility of a stagnating economy, but inflation still remaining stubbornly high. I think the base case on that is maybe a 20% chance that happens, but really, you don't know what's going to go on when you have wars like what we have happening in Ukraine and in Israel and Gaza. So the other area where we're starting to see some cracks is in corporate debt. A lot of corporations borrowed a lot of money or refinanced their debt back during the COVID era, and they did it on 3 to 5 year type terms. So a lot of these companies are now experiencing much higher debt payments than what they were just last year or even the year before. That's cutting into corporate profits. We're starting to see that come into some of the numbers. And so in order to get corporate profits up and continue to grow those corporate profits, corporations are going to be forced to do one of two things: either lay off workers or increase prices. Neither one of those are good options for Jerome Powell. So I think even though inflation's not where he wants it yet, he's going to be prudent and act and give us at least one rate cut this year, probably in the fourth quarter. All that remains to be seen. We'll keep an eye on it. And as always, I encourage you to keep the conversation open with your certified financial planner and make sure that you're on track for your goals to success. Thank you for taking the time to join me for this month's monthly economic update.